right, so welcome back, and now we're going to be continuing on with the last segment of Chapter 7, which is introducing you to periodic inventory sales. Now, in the previous chapters, right, Chapter 5 and 6, we talked about periodic inventory purchases as Chapter 5, and then Chapter 6 we introduced into the sales. In this case, sales is very, very important to the purchasing process or just perpetual inventory in general, because the idea is that every time we're going to update our perpetual inventory, we need to take into fact and consideration that when we purchase our items, we're going to update our inventory. And every time we make a sale of an item, we're also going to be updating inventory. So let's dive right into the sales section of perpetual inventory. So once again, of course, as we know, the nature of a business is to take, natural resources and produce basically a product or a service for consumers or just for people to purchase, right? So essentially what we're doing is we're going to be selling goods and services for the primary of our sales, right? That's our main core of operations, right? We're looking at merchandising inventory. So in this case, our main goal of operations or our main goal of generating revenue is to sell goods, okay? And what is going to be considered, or in this case, what's going to be included in the selling price of your products? Well, it's straightforward, right? Your selling price is going to be all costs that it took you to even obtain the asset item in the first place, or the inventory item. And you're also going to include a small percentage of profit, right? Because your goal is not to sell your stuff at cost, because you don't want to break even, because you need to make sure you make enough profit to go ahead and cover all the other expenses it takes for you to run your business, okay? And with that being said, sales tax is going to be included. Now, in this class, I'm going to keep it sweet and simple. 8.25% is all you need to know for this class. But once again, sales tax is going to be varied depending on what state and what county you do business in. Right? So let's go ahead and dive right into our very first example here, where we're going to go ahead and sell our products. So in this case, right, on June 1st, okay, 10 toys were sold at $9.99 each with sales tax of 8.25%, all right? And the toys were originally purchased for $5.85 each. So that's what it cost us to purchase that inventory, okay? So how are we going to record the sale? Now, if you notice this, why is the journal a lot bigger? Well, under perpetual inventory, not only do you need to record the sale at hand, so record that you received the money and that you earned your sales, but we also need to include another little journal entry to calculate the cost of goods sold and also to take that inventory item out from inventory. So we're going to be introducing you to cost of goods sold, which, yes, we've seen before. We've seen this terminology before, right? This is what it cost me to sell the goods that I purchased, right? Okay. But in this context, right, I already given you here, right, we're not going to talk about costing methods until chapter 8, which is tomorrow, okay? But we're going to just go ahead and play by ear, saying right here that we're given this piece of information that it originally cost you $5.85 per toy that you purchased, but you sold it for $9.99, okay? So let's break it down and start and do one thing at a time. So first things first is we need to recognize the very scenario at hand, which is to record the sale, okay? So in this case, assumption is that I must have received cash or placed it on an account. I'm going to charge sales and sales tax as well, okay? So we know if we sold 10 toys at $9.99 each, how much is my sales?
$99.9, no?
Yes, $99.90. All right. And then how much is going to be my tax?
$8.24175.
Good. So in this case, right, add those two numbers together, you should get 108.14 as whether cash or accounts receivable, whichever way that you receive the money. Okay. Now, that's just recording the sales. So the next section I'm going to do is I'm going to now record my cost of goods sold, right? Cost of goods sold is directly correlated to my inventory, right? Because when you sell something, right, I sold 10 items. So therefore, because those 10 items are in my inventory, I actually have to physically take it out now because I sold it. It's gone. It's no longer in my inventory. So in order to figure out how much it cost me, right, which I know it's $5.85, right? So therefore, I need to calculate that much amount and update my inventory to reflect that I sold 10 of those toys and I'm physically getting rid of those 10 toys out from my inventory. Okay? And if it cost me $5.85 for each item, how much is my total cost of goods sold?
$58.50.
$58.50, okay? Now notice this, like as you can see, your selling price, right? If you do the math here, you've gained about 40% profit here, right? Because you take the $99.90, right? You can't include the sales tax because sales tax is what you owe the government. So the $99.90 minus the $58.50, you probably get about 40 something, maybe 30, 39 or something like that. I think it's $41 profit. Okay, so that's how we deal with profits. But again, you're not the profit manager. So just as when we journalize this under perpetual inventory, right? The idea is you're updating your inventory every time you make a purchase and every time you sell an item. So in this case, I might have 100 toys left in my inventory. By taking these items out, I should now have 90. Okay. All right. And this will make a lot more sense once we plug our numbers into the inventory worksheet, which once again, we're going to do that tomorrow. Okay. So any questions in regards to journalizing a sale? Okay. Under perpetual inventory, you need to have 2 journal entries. One to record the actual sale at hand and one to update the inventory. Any questions?
No.
All right, that's it for 7.4. So 7.5, of course, you're always going to have the your customers that want to return items back to your store. Okay. Now, of course, there are many reasons why a customer would choose to have a refund or for a return, right? They don't like the product. It's broken. It's defective. It doesn't work. They're just unsatisfied with it. Maybe it was a gift and they just are trying to just get rid of it. Whatever means that they have a reason to return an item, they have any infinite reasons, okay? Now, of course, it is your duty as a company to make sure that when you sell your products, you want to keep them sold. You don't want to have unlimited amount of returns and allowances or anything like that because customers will take advantage of that and purchase an item, use it, come back and return it to you at any given time. So in this case, you want to set some kind of company policies So a good example is you can return it within the 2 weeks or 14 days, 15 days, 30, or even 60, whatever reasons. You can only strictly say this is final sale. You can do store credits. You can even do as far as issue a new product, right? I'll give you even exchange, okay? Just make sure that whatever company policy that you guys stick with or create, you keep that in mind, okay? And second thing, of course, if you are going to be refunding anything to your customers, you need to also refund their sales tax. Okay, so if you charge them, once again, that money is not yours regardless. It belongs to the government. It's their duty for customers to pay into society, right? It's their obligation, right? And all we're doing is we're collecting that money and we're going to pay it into the government. So in this case, we need to give back the money that belongs to the customer as well. Okay, so let's go ahead and do this example here. So on May 1st, okay, you sold 50 coffee mugs for $5 each, okay? And the coffee mugs that cost you $1.25 each. Sales tax is 8.25%. Customer A pays with cash, okay, for the mugs. So record this transaction. So let's do step by step first. Step 1 is to recognize the sale at hand, okay? So here's a good thing to keep in mind. The sale needs to happen in order for you to get rid of your inventory, okay? Think of it that way. If a sale never happened, there's no way that you would have the reason to journalize that you got rid of 10 of those inventory items, right? You need to recognize what happens first, which is a sale has happened. Therefore, you sold items, so therefore you have to update your inventory. Okay? So in this case, so if my customer paid in cash for the sale of 50 coffee mugs, what should be my journal?
Cash is your first line,
Mm-hmm.
and then a sales line, and a line for sales tax.
Good. All right, so let's do the calculations. All right, so what's my total sales going to be?
250.
Okay. How much is the tax going to be?
$20.63.
Good. So $20.63, giving me a grand total cash to be received $270.63. Okay. So there we record the sales. So now the next section we got to do is record that we sold items. So in this case, if each cup cost me $1.25 each, and I just sold 50 of them, what should my journal look like?
The cost of goods sold,
Cost of goods sold.
and then a line for just the coffee mugs.
Good. And what's my total amount going to be here?
$62.50.
$62.50. Good. All right. So that's just recording the sales of perpetual inventory, okay? Now, let's go ahead and see what happened in the next scenario, okay? So in this case, right, on May 10th, customer A wants to return 10 of those coffee mugs for a full refund, okay? And your company's policy says that you will give a full refund if you return within 15 days, okay? And the coffee mugs, once again, cost you $1.25 each. Record this transaction. So, in this case, right, sales is going to be identical throughout, whether it's periodic or perpetual. It doesn't even matter what the journal is, because in this case, we just need to know that sales is definitely, it's finite. You can't reverse sales, okay? So we need to create a contra account, which is sales returns and allowances, okay? Now in this case, customer A, right, originally purchased everything in cash. So we're going to give the money back in cash. Now in this case, just exactly how we did it many times before, right? This is a sales returns and allowances. So let's go ahead and just figure that amount first, and then we'll calculate the other amount later. So in this case, right, we have a sales returns allowances for 10 coffee mugs, okay? We originally sold each coffee mug for $5 each, okay? So how much is going to be my sales returns and allowances? $50, yes. And on top of that, because we originally charged the customer for sales tax, we got to give it back. So in this case, how much is my sales tax?
$4.13.
Good. So we must give this customer A back their money for $54.13. Okay. Now here is the catch here. When this customer is actually giving me a full refund, right, or they're giving me back the product, that means the product is going to be given back and it's going to be restocked, right? Now, obviously, in a real world matters, you wouldn't restock it to the same exact inventory account. You would stock it into a refurbished or a used items, or a different account. But this is just to make sure you understand the general idea. So in this case, if I'm getting a product back, what must happen to my inventory?
It's going to increase.
You're going to put everything back into the inventory, and you're going to reverse the cost of goods sold. Okay? So cost of goods sold is going to be one of the only exceptions for expenses that can actually be weaved in and out using debits and credits. Like that one you can reverse as many times as you'd like. It's just only operating expenses are kind of harder to undo. Okay, so here you go. You got coffee mugs, right? And you have the cost of goods sold. Now, if each cup originally cost you $1.25, how much is it to refund 10 of those? $12.50. So this idea here is that if a customer is actually going to bring back the inventory items back to you for a full refund, you must restock back your inventory exactly like this and reverse the cost of goods sold, because you didn't sell those items, right? They ended up getting returned back to you. So in this case, this is the journal that you have to recognize. Okay. Any questions here?
Nope.
Okay.
No.
So let's go ahead and move on to scenario 2. Well, what if on May 18, customer A wants to return 10 of those coffee mugs for a full refund, but the customer doesn't, because the customer doesn't like the color, right? This is just a separate situation. It's not continuing. And you tell them that they have actually missed the window to return those coffee mugs, right? And right, but you are willing to give them a 15% discount, because the thing about this is we're acting as if we're a small company, right? You want to make sure that you sell every product to each and individual person, because once again, you're a small business. You're not going to have customers coming in left and right. Your business is going to be growing. It's slow. You might have a customer here and there. So you want to make sure that you want to keep them as a customer, okay? And by doing so is though this person, they bought stuff from you and they missed the return date policy, and they're arguing, and they basically are unsatisfied with everything because they're trying to return the item because they just don't like the color. Now, you can do this. You can kindly offer them a 15% discount. Now, in most cases, once again, it just depends on what your company is. But in this scenario, this fake scenario, we're going to give this customer a 15% discount to keep them satisfied. Okay? So in this case, yes, once again, it's a sales returns and allowances because we're not going to give them back their full amount of money, but we are giving them a portion of the money back, which is 15% of the money that we're going to give back to them. So in this case, right, how should my journal look like?
Sales returns and allowances and sales tax.
Good. Sales returns and allowances and sales tax. And because customer A paid originally in cash, we're going to give them back cash. Okay, so they're trying to return 10 of those cups, but we gave them a 15% discount. So if the original selling price for each cup was $5, what is going to be 15% of 50? $7.50. And then tax, how much tax are we giving back?
$0.62.
62 cents. So therefore, they're going to get $8.12 back. Okay. Now here's the next question. Did customer A return the actual product back to the store?
No, because we gave them a 15% discount.
Correct. We told them keep it. We'll give you 15% discount to keep you satisfied. So in this case, you don't need to restock your inventory because we never received or got the inventory items back. So for allowances, you only need to just give them back their money. Okay? You're not going to restock your inventory because they never gave you the product back. So in this case, that's it for this section right here. All right? Any questions?
No.
Okay. Last but not least, 7.6, we're going to talk about discounts. So, as we've talked before many times, discounts, again, could be used for pretty much promotional purposes and to just get your products sold a lot quicker because a lot of customers, right, they're not willing to pay full price for an item. They rather, spend their money on purchasing things that are on sale because their dollar can stretch further. They could buy more things if things were on sale. So, and on top of that, when you sell a product and it's on sale, you're more likely to actually get stuff sold a lot quicker, especially when you're trying to get rid of your inventory. So sales is a popular idea, right? It's for promotional purposes only, grand openings, store-wide sales. It could be even online deals, okay? Now, of course, once again, this is going to be a company decision, but there are other ways that you can also give discounts as well, whether it's based either on terms, right? We talked about if you give your customers some discounts, those is another way that you can use the discount for. It doesn't have to technically be an in-store opportunity. Right? So let's talk about in-store first, okay? So here we have an example here. We're on June 1st. Your store is having a promotion on all items are 40% off, right? And a customer buys 10 baseball hats, okay, with cash, okay, which originally priced sales is for $10 each, okay? Sales tax is 8.25%, and the hats cost you $2.50 each. Okay, so record this transaction. So, like I mentioned before, let's break it down one at a time. And we're going to take a look at the sales portion first and then update our inventory. So, first things first, how should my journal look like for this in-store sales?
Should the first line be cash since it was a cash sale?
Yes.
And then we have a sales discount line,
Sales discount comes next. Good.
and then our sales tax.
Good. Sales and then sales tax. Good. So that's what we have to do. We got to recognize what our original sales is, because if you ever seen your receipt, right? Sales discount is always a separate line on your receipt. So exactly how we do it here in our journal is what we're going to do, right? We're going to record first how much was the original sales. So if you sold 10 of those baseball hats, which originally cost you $10 each, okay, so that's $100. What is their discount amount for? It's 40%, so that's $40. So how much tax are you actually going to be charging off of? Are you going to charge for the full $100 or for the discounted amount?
The discounted amount.
The discounted amount. So in this case, right, we're going to recognize sales was $100. The sales discount was 40, and the tax, which is off the 60 because that's what you actually sold in the store, 8.25% of $60 is $4.95 each. So that means the total amount of cash that you should be receiving is $64.95. Okay? Right? So now let's go ahead and calculate the cost of goods sold, because if each hat originally cost you $2.50 each, how much was the cost of goods sold in the baseball hats for?
$25.
$25. So we're going to recognize that we had a cost of goods sold, and of course our inventory item is going to be hats, okay, for $25. We're going to take it out of our inventory, okay? Straightforward. Any questions? Okay. Now, same scenario, except this time we're going to be having a customer that is going to receive terms. Okay? So then on July 1st, a customer wants to buy in bulk 100 baseball hats, okay, from your store on an account, okay? And because they were a first-time buyer, Okay. You offered them terms, which is 5%, 15, net 30. That means they have to pay you back within 15 days to receive a 5% discount. Okay. Each hat sold for $10 each. Okay. Of course, we have sales tax is 8.25%, and a delivery charge is for $10. Okay. So each hat cost you $2.50 each. So let's go ahead and do the same thing, but this time we're going to break it down with the actual sales first. So in this case, how should my journal look like?
Accounts receivable,
Accounts receivable, good.
a sales line.
Okay,
We need sales tax,
good,
and then the delivery charge for the $10 fee.
good. So in this case, right, because we have terms, terms is a condition. We can't take the discount just yet, especially because they didn't pay for it. So you can't use the net and gross method for this case, right? It's only purchases of inventory, okay? So in this case, right, this one is a sale, not a purchase. So we can't give them discounts right away. We actually have to wait because it's a condition. They have to pay first in order for us to recognize that they got a discount or not. So in this case, we're going to recognize the full amount, which is going to be for the $10.92.50, right? 100 hats at $10 each is $1,000. Okay, tax on that is $82.50 plus $10 worth of delivery charge will give you a grand total of $10.92.50. Okay, so now let's go ahead and calculate, because in this case, right, we've earned our sales, so therefore we need to update our inventory. So in this case, right, if it cost me $2.50 per hat, how much is my total cost of goods sold?
250.
Right? Cost of goods sold for $250. Okay. So then now, right, on July 12th, okay, the customer pays their purchases in full. So how are we going to record it if the terms were 5%, 15, net 30? Okay, so in this case, they paid within the discount pay period. So in this case, we need to calculate that 5% discount. How are we going to do that? If this was the original journal, right? How, now that this customer is going to pay for their amount that they owe, how much are we going to take the discount amount for, and how are we going to journalize this?
We're gonna get a 5% discount of $1,000.
Good, of $1,000. Okay. Right. What else do we need to recognize?
Their payment.
Their payment. Okay. Okay. So how should they pay us? With a cash or a check? Okay.
Let's see. So if they paid us cash, that would be our first line.
Okay.
And then we also have to account for the discount that we gave them
Good.
and any sales tax.
Good, because we charged them for the full amount of sales tax. If we're discounting them now, we actually have to give them back a portion of their money for the sales tax. So excellent. Okay. Now you said 5% off of 1,000. So what is that for the discount?
$50.
$50, okay? And the tax off of the $50.
$4.13.
Good. And how much does this customer actually owe me for the accounts receivable?
1038.37 minus 50. 1,092.50.
Good. So then, therefore, this is how much that they have to pay me, right? Is $1,038.37. Okay. So, with that being said, right, does this transaction affect inventory whatsoever?
No.
No, right? Because they're just simply paying for what they owe me. So, no transaction necessary to record anything about inventory. Okay. And that is it. So that we took a look at what happens when we had perpetual sales, right? We recognize that you're going to have the sales first, and then you're going to have a second entry to record the cost of goods sold and directly take out the inventory item that you actually sold, okay? If sales tax is included, sales tax is included, okay? We also understand about what happens when customers return products to us. So if that's the case, okay, you just have to recognize sales returns and allowances and however they paid, right? You just give them back their money. And if they do actually refund the product to you, you need to update and restock that item into inventory. If it's an allowance, you don't need to do anything because they never returned the product to you. Okay. Then we talked about discounts, right? What happens if it's in-store discounts versus terms, right? Terms, it's a condition they must pay in order to get the discount. Where in this case, if it's a store-wide discount, in-store, online, whatever kind of deals that it is, it's going to be a line for automatically for the sales discount. Okay? And you have to also remember, you cannot discount sales tax, freight, or any other expenses. You can only discount the actual selling price itself. Okay? So that's it for this. So let me see. Let me take a look real quick. See if we can complete this quickly. Okay, I think we can. Okay. So let's go ahead and quickly go through this right here. This is the exercise for 7.4, 7.5, 7.6. So here the task is to journalize and assume that sales tax is 8.25%. You purchased a total of 500 cups with all costs equaling to $1.36 each. Okay. So let's go ahead and dive into the very first one. On April 5th, you sold 100 cups at $5 each to customer A for cash.
So is that the one where we do the cash / accounts receivable?
In this case, I specified that you sold to customer A for cash.
Okay,
So
so cash,
Mm-hmm.
one line for cash, and then our sales and sales tax.
Good. Okay. So how much was it if I sold 100 cups for $5 each?
500.
Okay. How much is tax? $41.25. So how much total cash am I going to be receiving? Okay, good. Now you could put in your description that you sold 100 cups to customer A if you would like. In this case, I'm going to save it till afterwards because we need to also update our inventory, right? Because we have this line right here where each cup is going to cost me $1.36 each. So what's my cost of goods sold going to be? If it costs me $1.36 and I sold a total of 100 cups.
$136.
136, good. And you're gonna take that directly out of your cups inventory. Okay. This is where I'm gonna go ahead and include the line that I sold 100 cups to customer A. Okay. Okay. Then here on April 7th, you sold 25 cups at $5 each to customer B on an account. And you gave them 10%, 15, net 30. So in this case, we sold 25 of those cups on an account and gave them terms. So how should we recognize this? Accounts, not account receivable, good.
You have a sales discount.
No, okay, no, because this is terms. What's the condition for this person to get the discount?
Oh, so you have to pay.
They have to pay. Yeah, so in this case, we're not going to give them discounts yet.
So sales.
So just
and
sales.
Tax.
Good. Good. Okay. So if we sold 25 cups at $5 each, how much is the sales?
How much did you sell?
$5 each. If you sold 25 cups at $5 each.
125.
125. How much tax is going to be on that?
$10.31.
$10.31. So giving me a grand, a total that he owes to be $135.31. And let's go ahead and update the inventory and then we'll put that the description afterwards. So we sold 25 cups. So it cost $1.36. So what's the cost of goods sold going to be this time?
$34.
$34 even. Okay. And this time we sold only 25 cups to customer B, comma, right? I'm going to put that we offered him a 10% if he pays within 15 days. If not, it's due in 30. Okay. So then on April 10, we end up selling an additional 50 cups for $5 each to customer C for cash. Okay. So how should my journal look like? If I sold 50 cups to customer C on April 10. Okay. I sold 50 cups at $5 each.
250 cells.
Good. 250 for sales. How much sales tax?
6.25. 20.63.
$20.63. So then 270.63 is the amount of cash we should be receiving. Okay. Now we also got to update our inventory because we sold 50 of those cups and it cost me $1.36 each. So what is my total cost of goods sold here?
$68.
$68 you said?
Yes.
Okay. And again, you sold 50 cups to customer C. Okay. All right. So then on April 15, right, 5 days later, customer A decides they want to return 10 of those cups for a full refund. So this is customer A, right? Customer A, which we sold to them on April 5th, 100 of those cups at $5 each. Okay? And we sold it for cash. So in this case, customer A wants a full refund. So how are we going to issue this full refund for 10 of those coffee cups?
The sales return and allowances,
Good. Sales returns and allowances.
and then we owe them their sales tax
Good.
and a line for cash.
And a line for cash. Excellent. So in this case, how much is the actual sales that we're returning? Right? They're returning 10 cups, which we originally sold for $5 each.
So $50.
Okay. How much tax is going to be refunded?
$4.13.
Okay. Giving them a total of 14. I'm sorry, giving a total of 40. Excuse me, I'm so tired. It's giving the total ending or cash to give back is $54.13. So we're going to return 10 cups, right? For to customer A for full refund. Okay. All right. Now, here's the question. Customer A is going to be returning 10 of those coffee mugs for a full refund. So therefore, do we need to update our inventory? Do we need to restock these cups back into our inventory?
Yes.
Yes, we do. So therefore, we need to debit our cups and we're going to reverse the cost of goods sold. So if each cup will cost me $1.36 and I'm returning 10 of them, how much is going to be my total amount that I am going to be putting back into my inventory?
$13.60.
$13.60. Good. All right. And then you can even put a note here that you don't have to say customer A returned it. You could just say that returned 10 cups. Okay. Straightforward. Okay. All right. Let's see. I think we have 2 more dates here. Okay. So that on April 20th. Okay, customer C decides to return 25 of those cups, but is willing to accept a 15% discount. So here, customer C, right, they want to return 25 of those cups and is willing to accept a 15% discount.
Are we gonna have the same 3 lines, the sales return and allowances, the sales tax and the cash?
In this case, let's see. Yes, sales returns and allowances, the sales tax and the cash. Yes, that's correct. So let me go ahead and let's see this exact right here, except obviously the description is going to be different. Okay. So here we are. Sales returns and allowances. All right, and this was April 20th. Sales returns and allowances, and then we got sales tax payable and the cash that we're actually going to be giving back to customer C. So in this case, right, they are trying to return 25 of those cups, which we originally sold at $5 each, but they're willing to accept a 15% discount. So what is this total amount here going to be?
$18.75.
$18.75. Good, right? We're going to take that 25 times 5, which is 125, times that by 15% should give you $18.75. So then how much tax is going to be off on that amount that we're refunding? Or how much tax are we going to give back?
$1.55.
$1.55. So therefore, the total amount of cash we're going to be giving back to this person is
$20.30.
$20.30. Okay? And we're also going to make a note here. Now, question to you is, do we need to restock our inventory? No, because we convinced this customer to keep the products and just accept a 15% discount. So in this case, we could just journalize it that they got an allowance. Excuse me. Allowance on 25 cups for 15% discount. Okay. All right. Last but not least, we have here is on April 22nd. Customer B decides to pay for his purchases and he meets the discount. So let's take a look at when we sold to customer B, which was on the 7th of April. So here, 10%, 15 net, net 30. So in this case, right, how much, since we sold to customer B 25 of those coffee mugs, right, for $5 each, and we get to take a 10% discount, how much are we actually going to be discounting this?
$12.50.
$12.50. Good. So how should I journalize this? Because now customer B is actually just making a payment.
Cash.
Cash.
Sale discount.
Sales discount.
Discount. Sales. And sales tax.
We already record the sales.
So, sales tax.
Sales tax, yes, because we have to give them the portion of the money back because, right, we place it on an account. We charge them for the full amount, including the full amount of tax. And now that they're making a payment, right, and they're receiving the discount,
Okay.
we must give them their money back for that discount. So in this case, right, it was, what was it, Nancy? How much was the discount for? $12.50,
Yes.
right? How much is the tax going to be refunded?
$1.31.
$1.31, okay. Let's go ahead and check out how much we originally charged customer B. So customer B, we charged them $135.31. Okay. $135.31. So how much in grand total are we going to be receiving from customer B? One, 21.
121.50, no?
121.15, you said? 121.50 cents. Okay. Good. 121.50. And your final note here is to say that customer B paid in full, received 10% discount. Okay. Okay. And that is it. Any questions in regards to chapter 7.4, 7.5, 7.6, dealing with sales?
No.
All right then. Okay, well, that's it. That's it for the rest of today. So, for homework tonight, it's just to catch up on your reading for chapter 7 and go ahead and dive right into chapter 8 reading as well.